Yeah. So Keith Lerner, Mike, I'll come back to you in a minute. I mean, what we've teased here is that you've upgraded two sectors within this market, which to me plays right with the theme of where we started some 56 minutes ago. The idea that cyclical stocks are going to do well, the run it hot trade into 2026, you upgrade industrials and you upgrade materials. Tell me more.
Yeah, sure. And I will say longer term, we're not giving up on tech, but I think there's a lack of a near-term catalyst. We've seen this market burn out, as we all know, with the average stock or the equal weight index make a 52-week high. So we upgraded industrials to an overweight today. It just broke out of a five-month trading range. It's only up 2% since July, so we think it has some runway. And we do think it benefits from an uptick in the economic environment next year and this accelerated depreciation that we're seeing for corporations. Underneath the hood, Scott, we're seeing transports work, and then we're also now seeing defense stocks get back in gear as well. You put that together, we think that makes sense. On the materials side, we just upgraded that from an underweight to a neutral. So again, industrials is the overweight. Materials, a lot of the same themes, uptick in the overall economy. It's only up 7% this year. I think in the interim, people are going to still be looking to say, where does the money from tech go to? And these are some areas that would benefit from that and this uptick in the economy that we're anticipating.
Mike, it's too early to declare a trend change, obviously.
Sure.
But we're sniffing something out here in the market. At least investors are trying to, and more people are talking about it.
There's no doubt about it. I mean, it's been kind of gathering in that direction for a few weeks. I think everybody was getting very confident about just getting a little extra kick to consumer activity into next year. And the market's been migrating there. I do wonder exactly how open-ended the upside can be in those types of sectors until you start to get the earnings upgrade cycle, maybe kind of getting farther along. Meanwhile, overall indexes, too much pressure on the AI group as are we calling them CapEx vigilantes? Because that's kind of what's happening right here, and just a little bit of misgivings about whether we should kind of trust that the build out is well financed and well considered. I don't think there's much new there. I think the still looks like very normal kind of pullback, but we really have been chopping sideways for a while here at the S&P 500 level. Today's low, we first got to that level October 24th.
Hey Keith, we had a guest on earlier today who said you could do 15% in the S&P next year. I mean, if you do have a decided trend change, it might be hard to do that. Don't you think, if these big tech stocks take somewhat of a back seat?
Yeah, I mean, I think it could be a situation, not our base case, though, is that you see this rotation and you see a lot of stocks doing well, but the headline index not doing as well. But Scott, I ultimately still think in a week, in a couple of days where tech has been under pressure, I do think at some point next year money comes back to tech and that secular story. But we have to remember, I mean, off the lows, the tech sector was up 70%. That was double the S&P. There is some uncertainty. So you're rebuilding that wall of worry. I just think there's not a real clear near-term catalyst for them. But at some point next year, whether that's 3 months, 6 months into the year, I think money ultimately comes back into tech. And I mean, we're not big into price targets, but I will say when we look at the weight of the evidence in our work, it does suggest the potential of high single-digit, low double-digit returns for next year. But you need tech to at least participate in order to see that.
Yeah. Keith, I appreciate you joining once again. 15%, we'll see. It would be hard to do that if you have a slip up in tech.
It wouldn't be wild. It would obviously be a great 4-year run if you got 15% next year. You can't rule it out. It's more common to get a 15% year than it is to get like an 8% year, counterintuitively. So we'll see. Economic data next week, though, going to be interesting. Might change some minds on the Fed.